Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I am your host. At Investor in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together, we're going to make the best investments that we can, so thank you so much for joining us. Bret Jensen is a top 5 ranked analyst on TipRanks and an encyclopedia of investing and stock knowledge. We spent some time together today talking specifics. What are some of his top investment prospects in biotech right now? What 2 companies are most likely to be bought out next in biotech? And besides biotech, what sector he's excited about, including specific companies? And we talk about what he is expecting from the overall market as a whole. It's all here today, and I can't wait to share with you. And remember, our goal here is to help you learn to invest financially and in all of life. You can always find more at investorinthefamily.com. If you've been investing for any period of time, you've heard of Benjamin Graham's book, The Intelligent Investor. Warren Buffett calls it by far the best book on investing ever written. If you want to be a successful investor, this book is foundational, and I'm starting a special reading group focused on the intelligent investor and limiting enrollment to just 15 people. If interested, there is a link to the application in the show notes of this podcast, and if you're on the Investor in the Family mailing list, you've already received the application. Enrollment, which is free, closes in just a few more days, so don't forget to claim your spot, or apply for your spot, I should say. Thank you. And I look forward to hopefully seeing you there, and I hope you enjoyed today's interview with Bret Jensen. Well, hey, Bret, welcome back to the show.
Hey, Brian, thank you for having me back.
Man, it is always a pleasure to have you here with us. And we've also obviously done some interviews in the past where you've spent a lot of time sharing your personal philosophy for investing, and always very popular with our listeners. But we have you back this time because we would love to hear about some updates, as far as what you're up to, what you're looking at now in the markets, what you're watching, how you're feeling about market valuations as a whole. And yeah, I'd love to hear kind of what you're looking at and what you're excited about right now.
Yeah, great. Right now, I'm pretty neutral on the overall market. This looks like it's going to be the 5th quarter in a row where the earnings within the S&P 500 have fallen on a year-over-year basis. There's very little growth in the overall market. Obviously, the worldwide demand is at its lowest level since 2009. Brexit has really caused currencies to go ahead and fluctuate, and the dollar continues to go ahead and gain against most major currencies, which is a big headwind to earnings and revenues on American multinationals. In addition, the GDP now for the last 3 quarters has averaged about 1%, which is basically just above stall speed. So there's not a whole lot of growth in the overall market. So I'm fairly neutral on the market as a whole. However, there are some growth parts of the market that are starting to move and move in a big way. I think the last time we talked, I mentioned how undervalued I thought biotech was. It has bounced now about 20% off the bear market lows, but still it was about 25% below its peak last summer. You've had really solid earnings that beat expectations almost across the board from the large cap players such as AbbVie, Amgen, Bristol Myers Squibb, Celgene. One big exception with Gilead Sciences, which actually beat on the bottom line, but sales were lower than expected because the hepatitis C sales are dropping off faster than expected. Still a good value play there, but they're probably going to need to make an acquisition or see those sales in hepatitis C fall less in coming quarters. You also have seen a pickup in the merger and acquisition activity. I think one of the stocks we talked about last time we met was Replisa, which ended up getting bought out at a 60% premium by Galencia, which is a Swiss-based concern, on June 21st. You have Medivation, which is a mid-cap oncology concern, currently trying to fight off a hostile bid from French drug giant Sanofi. And it's solicited confidentiality agreements from some of the bigger players. There's something that might go for over $10 billion sometime in August. So the M&A activity is picking up. Yesterday, Biogen, which is like a $65 billion concern, went up nearly 10% of the market because there was rumors swirling that Merck and or Allergan might be interested in acquiring that large concern. So biotech's a very hot market right now. A couple of names I think that look good as a standalone or as a possible acquisition candidate would be Acadia Pharmaceuticals, which just got their drug Nuplacid approved as the first treatment for psychosis for Parkinson's, which is probably $1 billion indication, and also have late-stage trials going on for that drug to see if it can treat the agitation and psychosis that schizophrenia and Alzheimer's.
And what was that company again?
Acadia, okay. ACAD on the NASDAQ is probably a $4 billion market cap company. Biogen could be a logical suitor for it. I also like Synergy Pharmaceuticals, a smaller play, SGYP. They have a compound called plectinatide, which is a GI drug. It has a key phase 3 test for one indication that should be out by the fourth quarter of this year, and its proof of date or FDA approval date for the other indication that's already flown through trials on is January 29th, probably $500-600 million market cap, easily could be bought out for something like Allergan that's looking to make bolt-on acquisitions. The other strong part of the market that I'm overweight right now is housing. 2015 was the best year for housing starts since 2007. 2016 so far is up from 2015, but we're still way below the long run average of the last 30 or 40 years in housing starts. Obviously, mortgage rates are near historical lows. Job market's still solid. Credit standards are starting to loosen a little bit, and you have a lot of pent-up demand because household formation is now above where it was in pre-financial crisis times. You're also seeing the home builders being one of the few consistent sectors of the market this quarter to beat expectations. You got much better earnings today from Taylor Morrison, which is TMHC. Which I've owned since they were 11 back earlier this year when insiders are buying. They're now 17, but they're still only going for about 10 times earnings forward. Good play there. MDC Holdings also beat by a good margin today. I do not own that one. I do own LGI Homes or LGIH on the NASDAQ. They'll report tomorrow. I expect good things from them simply because their home closings in the first 6 months of this year were up 30% from last year. Still a cheap play. Lennar's another one that has beat and still has value here that I own. Other than that and some one-offs and some of the small cap plays, there's not a whole lot of value other than the consistent growers that you're going to have to pay some premiums on simply because they can continue to deliver growth. Alphabet, which everyone knows is Google, is one of those plays. It blew out earning estimates this quarter. Its YouTube division now has more revenues than Netflix, which is kind of an overlooked part of the company. It continues to dominate search advertising and obviously is big in digital and online marketing. So those are just some ideas in the market. I'm still avoiding emerging markets because of the currency issues. I'm also getting a little concerned that we're getting a little complacent here as far as oil goes, because remember, part of the big spike in volatility in the first quarter of this year was caused by the high credit market when oil got down to $27 a barrel because there's a lot of debt outstanding in the high yield market there. And since pre-exit, oil's gone from over $50 to right at 40. If we go too much below 40, I think those concerns are going to go ahead and resurface, which could bring more volatility in the market. And I would be using that opportunity if we do get a decline, if you don't have full positions in the biotech and the housing sectors, to go ahead and incrementally allocate into those sectors, because those are two of the few parts of the economy that seem to be growing on a consistent basis right now and have good value.
Wow. So you think you just shared more investing insights and stuff that I've had in my entire life. That was amazing. You So you shared a lot of stuff about biotech and housing. I want to go back a little bit and talk through a couple of those because, man, there's so much. This is fantastic. Okay, you mentioned Relipsa, which was just bought out maybe 2 weeks ago, which was obviously a huge win for anyone who owned that stock, including yourself. And then you mentioned a couple of stocks that you felt like none of us know, of course, but there's a high probability they could, experience an acquisition soon. And am I correct? You said Acadia and Synergy. Is that what you said were two of the companies you felt?
Yeah, those are two companies. Acadia's already had a nice run up, almost 80% since we put it in our Biotech Forum portfolio earlier this year. So I wouldn't necessarily be chasing that one. Synergy has really good value here. If you want another good value name that has key catalysts coming up, Progenics Pharmaceuticals, which is PGNX. They could also be a takeout candidate, but that's probably going to be a little complicated because they have a distribution and marketing deal with Valiant Pharmaceuticals around their key compound, Relistar, which is another GI compound. It just got approved on January or July 19th as an oral version. The injectable version has been around since 2008, I believe. And they're doing about $17 million of sales a quarter on that. But the oral version obviously is much easier to go ahead and take and will probably triple sales. They also got a $50 million milestone payment based on the approval from the FDA from Valiant. They have another $200 million worth of sales milestones they can make from Valiant as well. And the approval will obviously accelerate the timeline where they can do that. Obviously, it will accelerate their royalty stream as well. Good cash position. They also have two compounds. One is an imaging agent, 1404, that has key phase 3 trials coming up by the end of the year. And Zedra is another compound that has key phase 3 trials that should be out by the first quarter of next year. So they have good sales trajectory, good cash position, some upcoming catalysts, selling for about $6 a share, a couple $100 million market cap, and again, a possible takeout candidate, although not as clean as Synergy would be.
So then that's Progenics.
Yeah, PGNX.
Man, so would you say you have a photographic memory?
Unfortunately, that and a lot of coffee.
I mean, I could see like a biotech pharmaceutical rep spending hours a day trying to remember the details about a few of their products. And you just, in 9 minutes, explained the product line for about 10 different biotech companies, including their bottom lines and whether or not they're a candidate for acquisition. That's remarkable. And I'll just assume you're pronouncing them all correctly because I would have no idea.
It's not as good as my knowledge of the underlying fundamentals at times, especially after 3 cups of coffee.
Man, well, you're clearly in the right industry because you've got that coffee aside. You know your stuff, and I have some insights as far as how much time you're spending doing this, and you put so much labor into what you're doing and serving your listeners and followers. And so from that end, I thank you and thank you on their behalf. And so, okay, you spent a lot. So you talked about, let's stay with biotech for a little bit longer. You mentioned Synergy and Progenics as great takeover candidates, and they still offer some good value. Can we talk about Gilead for a little bit? Because that's in my observation, that kind of feels like the Apple of the biotech space. It's been the company for a long time now that most people will look at and say, hey, this is just a solid company. It's going to do great. It's underpriced. Stick with it. But it continues to not turn that corner. You mentioned
it really is. Apple's a good comparison. Apple, before they came out with the larger screens and when they supposedly lost their mojo, one of those things where they keep declining despite the fact they had great cash flow, great balance sheet. Gilead's the same way. I have a little bit of a different perspective on it simply because I've had it since 40 back in 2012, so I'm still sitting on a double. Tremendous free cash flow yield here. They produced almost $5 billion of operating cash flow in the last quarter. Some of that kind of got overlooked on the disappointment on the hepatitis C sales. which equates to like a 15% annual free cash flow yield, which is ridiculous. Great balance sheet. And people are ignoring the other part of their business. I mean, remember, they are still the leading HIV provider, and the other part of their business is over $3 billion a quarter and growing in the mid-teens. You know, if you put a 4 or 5 times sales, which is pretty much standard in the industry, that's probably worth $60-75 billion of their almost $100 billion market cap right there. Great balance sheet, has some debt, but they also have $25 billion in cash. And you're really giving no value whatsoever to their pipeline. They have like 40 different candidates in various development stages. And hepatitis C sales may be falling, but remember, they did $19 billion worth of sales last year. This year it may come in slightly under $15 billion, and maybe next year it goes down to 12. But, those are 90% margins. And they got a lot of opportunities to use that cash flow, whether it's stock buybacks, which they've done a lot of. I think what right now they need to do 3 things. Number 1, continue developing the pipeline. They've got compounds targeting NASH, which is a liver disease that is growing because it really affects more when obesity gets involved, and as the Western world gets more obese, by 2020 is predicted by the leading cause of liver transplants, a $30 to $40 billion annual market, 5-6 years out. They're heavy into that. I expect them to make some acquisitions in that area. They also have a collaboration deal with Galapagos around a compound targeting inflammation diseases, including rheumatoid arthritis. Late stage, you get some readouts later this year. They also should probably do a significant acquisition, which they've said they are looking at but haven't done yet. And then, the fail-safe is they got so much cash flow, they says, we're going to stop the buybacks and we're just going to double the dividend and we're going to yield 4.5%. And that would be the easiest way to go ahead and correct that multiple, which would go from about 7 to 10 almost overnight. So it's one of those plays that's really frustrating and has been frustrating for 18 months. But they got a lot of levers to push, and they are a good long-term buy and hold. They're not going anywhere.
Yeah, that's what it feels like. It's the kind of company that, because it appears undervalued from just from a valuation standpoint, in biotech, an undervalued company is exciting because they can move fast and they can move big, just like with tech. But with Gilead sitting on the sidelines or not making that step for a long time, I think a lot of investors can get bored, which I continue to believe is one of the biggest enemies of all of us as investors, is boredom and impatience. Bottom line is, all the great reasons that anyone bought Gilead at a year ago, 2 years ago, 6 months ago, or today are still there. And so if you're willing to have patience, it sounds like it's still really a great place to have your money.
Yeah, it's one of those things. If I had to go to a desert island and I had 5 stocks, I'd have to pick and let sit for 5 years. Gilead would definitely be out there. Remember 5 years ago, the investors got impatient with it. It's a one-trick pony and only has HIV. And they bought Pharmaceuticals for $11 billion, and that's where it got its hepatitis C products and ended up basically raising its earnings by 600% because of that. So they've got a lot of levers to push, good management, disciplined management. There are other parts of the business are just fine. They're not valiant. They're actually keep lowering their prices, and they got a great balance sheet. And if anything, they're kind of suffering because they went out and found a cure for something instead of just having something that you need to go ahead and take every week.
Yeah, wow. Yeah.
If you look at it, they've last count on the last quarter, they've treated like 800,000 people in the United States, Japan, and Europe. 800,000 people are basically cured of a disease, and all we can think of is why aren't they making an acquisition?
Right. Yeah, it's like, well, let's think about why the company exists in the first place for just a moment, maybe. Okay, you just brought up, you made a nice little imagery here. Okay, you on a desert island, and if you could own 5 stocks, I'm going to totally put you on the spot right here. And if you're not ready for this, that's fine. So if you could pick 5 stocks right now to buy and hold for 5 years more, could you name Could you pick 5 right now, or would you need more time for that?
I think, just off the top of my head, Gilead, Celgene, which has not only great growth, but a huge pipeline. And they're in every area because of collaboration deals and equity stakes. They're almost like a VC to the biotech industry. So any major developments in the next 5 years, they're going to be a part of, and probably a major part of it. Another one, obviously, would be Google or Alphabet. They're not going anywhere. Facebook, although it's expensive, you're talking 5 years out. I mean, they just passed 1 billion users on Instagram, WhatsApp, and 1.7 billion on the Facebook.
It's amazing.
Yeah, it's amazing. You can't imagine going that doing anything.
Right.
It's ridiculous. So that's 4. You could probably go with another biotech like AbbVie that yields 3.5%, has a good pipeline, not quite as good as Celgene, but offset by a higher dividend. So those are 5 I would take in a heartbeat. I think in this market, you're just going to have to be patient. I would also throw in a stock that no one's ever heard of today that's actually selling off a little bit. It's a little lodging REIT called Chatham Lodging Trust, CLDT. The guy who runs it, Jeff Fisher, he took Innkeepers USA from 7 hotels in 1994 to 2000 to 74 hotels in 2007. Managed to sell out. This is before everything went into the toilet. Averages 13.1% return annually, including dividends over that time frame. I've owned it since 10. It's selling at 22. It pays almost a 6% yield. They have, they just concentrate on these, Hampton Inn type stuff. It's not exciting, but
good.
Personally, I think 6% return annually over the next 5 years. Probably looking at hindsight, it's going to look pretty good because we've pretty much used most of the central bank's ammo. And if economic growth globally has reset to a much lower level, which it looks like it has, we're not going to get the same stock market returns. So getting some dividends up front is probably a smart idea. And this is a really smart operator.
Well, at the minimum, we've gotten a new idea for a new newsletter for you called the Bret Jensen Desert Island Newsletter. It's a one-time buy-in.
Yeah, unfortunately, I live in Miami, and I'm just not an island person. Now, the only island I really like is Manhattan. So.
We'll start small. We'll get there soon. Well, maybe we can work toward wrapping things up a little bit with what you just said. Okay, we started by talking about, you said you're market neutral. Overall, you're not optimistic, you're not super pessimistic about it, but you just talked about central banks being out of ammo. That's not a new idea. We hear that talk out there, this idea of ongoing slow growth in the markets. But I don't know, I think we hear those things, but people are still wrestling with what that means, and no one knows. We don't know what's going to happen, but I guess maybe you've already answered the question. For you, that means, what does that mean? Do you feel like you need to be defensive more than normal, or are you just going business as usual until some other trigger takes place?
I think you need to be a stock picker, but the defensive plays are some of the most dangerous parts of the market to be in right now. I mean, you've got utilities who've been bid up by everyone looking for income. They're selling at 19 times forward earnings. They're yielding 3.1%, which is the lowest level they've done since the financial crisis. There's no growth. And consumer staples are kind of the same thing. Most of these things like General Mills, they yield 3%, but they're growing 1% a year on the revenue side. And they're, to me, some of the most defensive names are some of the most dangerous. I mean, either, we do get growth, and if that happens, then, the interest rates are going to go up and everyone's going to abandon these sectors of the market and you can get hurt. And if we keep going along like it is, you're getting no growth. So I'd rather personally be in cash.
Wow. Okay.
Or I would be liking something like Gilead that's generating a 15% free cash flow, or Apple still generating a huge cash flow. Great balance sheets and paying about the same dividends. I'd rather have dividends and growth than dividends and no growth.
Hard to argue with that. Awesome. But yeah, the fact that you shared what you did about biotech, and then you jumped into housing and then defensive plays. It's just amazing. So thank you so much for giving us some of your time today, and just the encyclopedic knowledge you have of all these picks. Again, says a lot about you, and we appreciate what you're doing for the rest of us out here trying to figure things out as well. And man, have a great rest of the day. Thanks, Bret.
Thanks, Brian. You do the same. Thanks for having me on.
Absolutely. Well, hope you enjoyed today's interview with Bret Jensen. Remember, you can get full show notes with links and other details at investorinthefamily.com. And if you want to be a part of my special, The Intelligent Investor Reading Group, don't forget to apply. We're closing up applications very soon, and enrollment is limited to 15 people. Fill out the application on the show notes to this article, or to this podcast, I should say. Or if you're on the Investor in the Family email list, you have already received a link in the email to the application. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.